All right, welcome to Intermediate Module 4. So yeah, we'll be talking about strategy development. How do you even trade this market in the first place? Like, what are you saying that is telling you that okay, you need to buy or you need to sell? So this is trend impulse strategy. Like I said, I do more with structure. I love and understand market structure. So we are basically just following what the structure of the market is saying. I think that's the right way to always approach the market. So trend impulse strategy. First thing you want to do is what? Is define the environment. All right, it helps you define the environment market condition filter. Before trading, your system must answer: is the market trending? Is the structure clean? Are we in an inspiration phase? All right, you want to be sure of this. Those are the first core 3 questions that you want to even ask yourself. Is the market trending? If it's trending, what structure are we in? Are we in the up or in downtrend? Is the structure clean? You want to pay much attention. Like, is it going to convince you? Because, like I said, the market never owes anybody clarity. But then is it a clean structure or it's just filled with spikes and impulsive volatility? Are we in an inspiration phase? All right, you want to focus on that as well. So a valid uptrend must show what? Higher high to higher lows, strong displacement candles, shallow pullbacks. All right, no deep retracement. That's to show you that what the market is going upward. Okay. Now a valid downtrend must show what? Lower low and lower high, strong bearish displacement and weak bullish what? Pullbacks. Right? That means the pullback that happens what? In a downtrend is not strong. It's mostly just up to 70% or 61% of the impulse move. It's never up to 90%. Once you see a retracement that is up to 90% or more of the retracement move, then of the impulse move, then something is wrong. All right. So if the structure is not clean, then you do not want to be trading. So the entry model is that the first thing you want to do is to what? Identify the trend on a higher time frame. Right. There are possibilities whereby the higher time frame will tell you that the structure is bearish, and then the lower time frame will tell you that what? That the structure is bullish. Higher time frame over the lower time frame every single time. So depending on what type of trader you are, personally I use the daily of 4 hour as the highest time frame that I have sometimes. So one daily of 4 hour to confirm trend. A trend is early identified when there is what? A low to a high to a higher low to a higher high for an uptrend, and then a high to a low to a lower high to a lower high for what? A downtrend. So to make it make more sense, we're going to make it a little bit more practical. So it said that we have a low to high to a higher low to a high high for an uptrend. So that's what we're starting from here: a low to a high to a higher low to a high high. That's for an uptrend, and then a high to a low to a lower low, but to a high for what? For a downtrend. A high to a low to a lower high to a what? A lower low for a downtrend. Then step 2 is that you want to wait for a pullback. You cannot chase impulse, right? Impulse is the actual move of the trend. So you cannot chase impulse. You wait for a pullback. So the pullback what is the internal structure formation. So you use your Fibonacci from previous low to previous high, right, to verify a valid pullback, which usually comes down to what? Down up to the 50% zone or 61.8% zone, right? So most of the time you use what? Many of times, if I'm trying to catch the impulse move of a structure, I always use my Fibonacci. It makes it clean. So we want to what? Trying to use Fibonacci from here, previous low what to previous high, and before this could be called AI. All right, you need to see price must have been what? Retracing already. All right, price must have formed a low, like a bullish and a bearish candle at that point, and then you see what price is what? Already retracing, probably almost back to this area, or maybe a little bit more, but let's make it seem something like this. Right, so I'm going to move this like this here. So for the bearish structure, you need what? From the high to the low. So we want to see price will come down to this area, and before you draw your Fibonacci, like I said, you have to make sure that what? A form of reversal is already even happening. You can't just hop up to a particular place and say this is the high or this is the low. So price must have already been reversing. So we want to like see the level of retracement, how deep it is coming. We are expecting it to come down to what? To the discount zone. We don't want to see price in the premium zone. Now when it comes to a bearish structure, all right, the premium zone is what? Is from this 50% down to 0. The discount zone is 50% what? Back to 1. And in a bullish structure, what? A premium zone is what? The premium zone is what? This 50% back to 0, and the discount zone is this 50% what? down to 1. So we want to see price was coming to this 50% or a little bit down. All right. So when we see price already in this sort of area, we start to what, pay attention to our candle formation to give me a signal that you should enter the market. All right, this is where we start focus here, because we're expecting what, we're expecting price to what, to now sell. All right. So study of liquidity, liquidity gap, stop pumps, stop orders would still be explained in another video. I feel like if you're trading structure, you need to understand how liquidity works properly. How to understand. So step 3 is what you want to enter on a continuation break, right? The box mode entry model, or maybe you're using an engulfing pattern, right? Those things are very, very convincing. Now the box entry model on the 1 hour or strong engulfing candle to the trend direction. That's how you enter on the continuation break. Like I said, once we're in the zone, once we're in the discount zone, we want to start paying attention to the candle formation. So it gives you a signal to enter the market. You do not want to miss it. So the stop loss is what is below the engulfing, right? The box model has an engulfing, definitely. So the stop loss once you're seeing an engulfing candle, to me, the best candlestick to enter a market is an engulfing candle, right? So when you're seeing an engulfing candle towards the market, the direction that you're looking for, that's a strong conviction, right? So your stop should be below that engulfing. Market might eventually stop you out here, alright? But many a times there's no valid reason why markets will come back to an engulfing candle, because especially when the engulfing is with strong displacement, right? There's no it does not really happen that price will work, especially when it's in the trend direction. That price will close it back almost immediately, but nothing is 100%. So the edge confirmation is that what you want to see your trend line alignment. You know, I was talking about confirmations of what you would see to make sure to verify why you're taking a trade. Trend line alignment, valid pullbacks using Fibonacci, old support turning into new resistance, or old resistance turning into new support. Then the box entry model on the graphic card, right? These are just things you need to see. We're not seeing a lot of things, right? And this can be filtered, right? Each of these edge confirmations can be filtered from a low probability trade to a high probability trade setup, right? They can all be filtered. You might see a trade and you might just be seeing, out of this 4, you might just be seeing 2. Some you might be seeing 3, right? So when not to trade, you don't want to trade when the market is ranging. If you're just starting out, you don't want to trade in a consolidation market. I personally do not trade in a consolidation market, right? Only sometimes. So you don't trade in a ranging market when pullback is too deep, right? So when you're expecting a retracement and the retracement is too deep, it's about covering almost 90% of the previous impulse move, right? Something is wrong. You want to start paying attention. Are we trying to catch liquidity? Liquidity is trying to break and to catch the orders below the low. Yeah. So zero entry confirmation. Once you're not seeing a confirmation, you should enter the market. For why you should enter the market, then you should not enter, right? Because that is the final decision. That's the final thing you see to enter the market. So if the pullback did not get validated by the Fibonacci, that means the pullback is just stuck in the premium zone. Alright, you don't want to buy or sell that type of market, right? It's risky for you. So for intermediate mode before this brings us to the end of it. I'll see you on the next one.